But normally the way things work is that you have a crisis in some part of the credit market or in equities right around the time the Fed starts cutting in the US. So it's not that things get better when the Fed starts cutting, it's that things get dramatically worse just as the Fed is cutting. And so you have a year or a year and a half crisis before lower interest rates and a rising money supply have their effect. That's the way it's happened, well, basically since the 1970s. So for my entire adult life, which is pretty long at this point, that's the way it's gone. And we're back in that kind of a situation again. So I suspect it'll go the same way. Unless, one thing that would short circuit the immediate crisis scenarios, the Fed comes in and cuts interest rates by multiples of a point. In other words, instead of half a point, they do 2 or 3 percentage points off the Fed funds rate. That's not going to happen. That's too big of a move in too short of a time. And that even might backfire because it might imply to the markets that the Fed is panicking because what they see is so much more horrendous than what is being reported in the mainstream media right now. So there's no real solution at this point when you've got a zero savings rate and falling consumer spending and geopolitical chaos and an incipient banking crisis. You throw all these things together and yes, the Fed is going to cut. And yes, they're going to go to QE again in the not too distant future. And yes, the government is going to run $2 trillion deficits. None of that fixes all these imbalances. You can only fix these imbalances with a lot of these debts being wiped out. And that has to happen through default at this point.
Okay, I know some people have mentioned that they could be sort of similar to what we saw in the 90s, where, they did the magical soft landing where inflation came down, there was sort of a small uptick in unemployment, they reduced interest rates, and then everything was okay. But you think it's sort of too far gone for
Oh yeah, like the imbalances this time around are immense compared to the 1990s. People forget that in the 70s, 80s, and 90s, we actually had pretty good finances in the US. The amount of debt relative to GDP was minuscule compared to what it is today. And consumers weren't nearly as indebted. Credit cards hadn't really taken off yet, become a thing that you put your gas on and your groceries on or anything. So we were able to handle slight increases in interest rates in the 1990s with much less trouble. But what happened in the 1990s? We raised interest rates a little bit early in the decade. There was a little bit of a mini crisis in 1994. And then the dot-com bubble started and everything just exploded. And at the same time that was happening, the Fed was stepping in around the world, bailing everybody in sight out. So you still did have really aggressive interventions in the market. But now, consumers are vastly more indebted than they were back then. The government debt is 3 or 4 times as high, not just nominally, but in terms of percentage of GDP as it was back then. And it's global. And we've already had our version of the dot-com bubble in the AI bubble of the last couple of years, when a handful of stocks just went from being a few $100 billion market cap to $1 trillion plus. So we've got a stock market that's supported as it was supported by a handful of tech stocks in 1999. So we're set up as if it's 1999, not 1994. And that means that there really isn't a solution except a repricing of all this stuff. Houses are as unaffordable as they've ever been. They have to go down by 50%. The cost of a house, that includes the mortgage. So interest rates going down will help, but prices also have to go down at the same time. So you got to cut the effective cost of home ownership by half, which is very deflationary. And stocks are wildly overvalued, and they're supported by just like 10 big tech stocks. So the S&P 500 and the NASDAQ have to go down by their typical 20 or 30 or 40% in an equities bear market before we get back to fair valuation. So all these things have to happen. We have to have all these repricings. And that usually takes place in the context of a recession. And usually the recession is caused by that repricing. So I think that's where we are.